Greetings, friends, and welcome to the Financial Games Special Edition. Ferdinand Roaño here with me, Jose Miguel Crespi, as always. In this episode, as we always do, we first discuss the global economy, macro impacts, and traditional markets. In this episode, we always talk directly about what is known as the alternative area.
Correct.
Alternative investments. Mainly real estate, which is private real estate, mainly not necessarily syndicates nor capital funds or investment funds, simply more private real estate, private deals. Jose, welcome.
Glad to be back here. Yes, in the episode about the alternative ones and recording, today, given the time of year, we've also included a little bit of information on tax planning.
Yes.
We're right in the middle of payrolls, tax returns, strategies. How do I protect myself? This morning, I saw a reel on Instagram from some tax advisors in New York, and they were talking to anyone who has a W-2 income of over $2 million and has to pay the IRS six figures every year, saying, "Oh, call me. I have a strategy," and I found it interesting. He specifically said, "2 million or more. If not, don't call me." So yes, this is the time when advisors who often specialize in tax strategies do more marketing, obviously, and try to reach their target market and talk a bit. We, as Puerto Ricans with a presence and firm in Puerto Rico, have one of the best tax strategies, I think, internationally, thanks to the legislation over there in Puerto Rico.
Absolutely.
But regardless, here in the United States,
in fact, there are already some changes coming to Act 60 where a 4% tax will be imposed, and some changes where those funds have to be reinvested and proof must be provided that those funds are being reinvested in Puerto Rico and that they are creating jobs. Right now, that's the main focus of the changes that they are making to Act 60, which I think is very good.
Yes, they're fine-tuning it. It's really important to measure the impact as well, right? You always have to measure the impact of this, which from the beginning has been extremely positive for the economy. There's no doubt about it in Puerto Rico. So yes, for those who don't know, we are advisors to
several
funds under Act 60 in Puerto Rico, but there's one in particular that's more focused on real estate, which is why we also go a bit more in depth about that type of asset. Ferdinand, what are you seeing as a real estate manager? What are you looking at knowing that we have projects here in the United States? We have income properties in Puerto Rico, and you're constantly monitoring the data regarding that market.
Well, at the beginning of the year, we saw an increase and a pickup because there's no doubt that there is still demand. Demand exceeds supply. There's no doubt about it. Permits for new construction, both multifamily and new housing, have decreased substantially since September or August of 2025. And we've seen an increase in demand. That demand was accompanied by the drop in rates we saw before this situation, before this shock we've had with oil in the case of Iran. And at that time, we had even seen increases in the price per square foot of many of our projects. Even so, the national average has remained between 3 and 4%. In real estate, it's the same in Puerto Rico. Anything that's income property, anything that's rental, moves quickly. There's no doubt that right now, in terms of capital, also here in the United States, remember that accelerated depreciation comes into effect.
A very good tax planning tool for the United States.
At this moment in the United States, for example, if you used to depreciate a property over 27.5 or 28 years, now you can accelerate it to 3 or 5 years, and you can even get bonus depreciation in the first year. That means that almost all income properties become exempt because of that depreciation and that expense in the net operating income. There is no doubt that in terms of resilience, due to the structural situation we have where there is more demand than supply, right now it is believed that there is a deficit between demand and supply of 4.2 million units that should already be on the market but have not been produced for housing. There is a conflict. Is it better to rent or is it better to buy? There is no doubt that right now, as interest rates go down, which have actually stopped decreasing, and everything seems to indicate that this year we won't see the rate cuts that home builders were hoping for, and even we were somewhat hopeful for, we now have to face reality. We can't count on that. at this moment
It continues to
move further away and accessibility continues to be difficult. Therefore, what we've seen in terms of trends, and we've spent the last 2 or 3 weeks running analyses on how much should go to resale, how much to rental, and what the ideal asset allocation should be between build to rent and build to sell. There's no doubt that the outlook has changed. From what we had, which was a 70-30 split, Jose Miguel, 70% build to sell because we saw rates dropping, and 30% build to rent, this has flipped 100%. AI has given us analysis with the latest metrics from Southwest Florida, and everything indicates that it should be the other way around. It should be 70 to 80% build to rent and 15 to 25% build to sell. Because of this situation and what I call a Maria's bath type of economic growth, right? Not too hot, not too cold, but with inflation patterns that will keep things in check, or with interest rates that might drop, it definitely makes us think that build to rent is the way to go.
it generates positive income for you. You're going to maintain that average 3% annual appreciation on your property.
Correct.
You open up the range to this is very important when you have a robust income property portfolio. A developer like Pentax Homes opens the door to perhaps the institutional investor buyer who might want to allocate to residential real estate. So you have an additional quite interesting market there. That's the beautiful thing about real estate. It's that flexibility. At any moment, if the market metrics indicate, Ferdinand, that it's better to sell the asset, you go to market.
Well, you definitely do a refinancing because rates start to drop. You take out the equity from the appreciation, and then you build another strategy. You pivot and then implement another strategy. I mean, that's what you do. If you look at it historically, the other important reason is that in the housing sector, the asset class is resilient. Resilient means that it is extremely resistant. Let me give you these statistics. From 1973 to 1975, which is the period that resembles what we have here, which was the oil embargo, it was caused by oil, the recession, housing, and we had what is called stagflation. This inflation, in Spanish it's called inflación, is what happens during stagflation. It's the combination of high costs with an economy that isn't growing much in recession. Well, mortgage rates in 73 to 75 were at 9.7%. Look at the difference. I want to put it in perspective and analyze it. And as El Chapulín used to say, don't panic. If you really look at it, right now the mortgage rate is 6.5%. If you have good credit, you can get it at 5.90, 6%. Let's say 6%. 6% is the average mortgage rate over the last 45 or 50 years. Between the ridiculously low 2.95% before COVID, the passes, and the highest, which we're talking about now, from 1980 to 1982, when the mortgage rate reached 17%. Did you hear that right? It's not a typo. Mortgage rates were at 17% between 1980 and 1982 as a result of inflation from the oil embargo. Okay? All right, 9.7. Home prices only dropped by 4%. So housing prices tend to have a certain resiliency because of what you just mentioned. You have the option to rent it out and you can generate cash flow.
It's flexible.
The other comparison we have is with the recession from 1990 to 1991, and that one was caused by the Gulf War. At that time, just so you have an idea, mortgage interest rates were at 10%. And housing declined by 6%. There are two very important factors that are different from these two economic scenarios. First, the productivity we have now is not the same as in those years. You have AI, which is a deflationary factor. Technology is a deflationary phenomenon. Second, the United States is a net exporting country. This means it is not totally dependent on oil from Saudi Arabia or the United Arab Emirates. Third, inflation, even though it's above the numbers, is above the numbers because the Fed's target is 2% and we're hitting almost 3.5 to 4%. Therefore, fourth, supply versus demand during these periods of time was balanced. There was more construction and demand was quite balanced. At this moment, it's the other way around. Demand exceeds supply by a wide margin. Therefore, my conclusion is that if we base ourselves on history and on economic scenarios of construction, supply, and demand, I believe the housing market is going to have a lot of stability, and that's very important. What happens after recessions? What happens to real estate prices after those periods of difficulty or volatility? They have increased on average between 12 and 20% after that period. Therefore, it's exactly what you just said. You hold on to the property, you get cash flow from it in our area. One of the advantages we have in Southwest Florida is that there are no HOAs. Property taxes are possibly 40 to 45% of what is paid in the East. And typically, properties in general have a pretty good net operating income. In fact, in the simulation analysis I did, the average rent in my hypothetical scenario was $2,500. Do you know why I set it at $2,500? Because $2,500 is the typical average for a house between $160,000 and $370,000 with a 6% mortgage. So then I really compared, if I were to sell that property, I would have to pay a series of costs versus renting it out for the same amount where I'm preparing that renter. So that eventually they might buy it if they get excited about the property. And so you're creating an exit strategy, because if there's an increase in the property's equity at the end of that period, you can easily offer terms to that buyer to convert it. And typically, after these periods when we go through inflation, recessions follow, which then start to lower the cost of money because the Fed shifts its approach towards stimulating the economy.
Correct. And
start lowering rates and supplying more liquidity to the system in general. And
there you have a pool of buyers to be able to move.
That situation forward. And that's why the BTR phenomenon becomes more attractive right now compared to BTS, which is built to sell. That's why I wanted to explain. And I'll take this opportunity. Besides this, it's an explanation that we've given in the webinars in your area of markets and my area of non-traditional. Another important point is that despite everything that's happening, Jose, I know there's been talk about private credit because of some general situations, but private credit that is really well collateralized continues to be a good asset. Of course,
private credit, for example, tied to real estate, like what we're talking about, continues to be an excellent alternative. Very important. I'm glad you mentioned it. I actually want to address that first. That situation, that news, that information coming out about private credit is more related to credit in technology companies and especially startups. Startup companies, young loans to technologies that are still unproven. So it's more focused specifically on technology. It's not all private credit. There is very high quality private credit out there. Private credit tied to real estate is an excellent alternative. So I wanted to cover that.
It's important to clarify this because honestly, sometimes people get confused. Not all real estate is the same. Not all private credit is the same. So sometimes the situation gets generalized and these scenarios are created like, look at this situation with private credit. This is a 2008 crash. Folks, it's totally not at all. We're not talking about a situation like that. 2008 was a one-of-a-kind real estate situation, which I really think is an event from which the banking sector has learned a great deal. But it's not a bad thing when these kinds of spirits, as I call them, these situations from the past resurface, because having these situations makes you more conservative and more prudent. And that creates balance and equilibrium in the system.
Many of our analyses are based on, we do the famous stress test, just like at the cardiologist, right? When you go to the cardiologist, we do the famous stress test, acid test, right? Which means going back to those years and seeing how my strategies would have performed. They are excellent analyses to carry out. We've been doing them. And the art behind all of this lies in how we combine these different assets, these different strategies. In the previous episode, I talked about some strategies that can be used in relation to the markets depending on what the investor is looking for. Today we've talked about it, and private real estate or investments in real estate with strong collateral are an essential part and can be integrated when designing a portfolio. especially if we want a portfolio that consistently generates good income. There are alternatives, so we can go into more detail, as I always say, a little bit more. And we are available for anyone who wants to discuss this.
And also, for those who follow us, know that you still have until April 15th to explore capital fund alternatives under Act 60. The management letter for the Panoramic Fund has already been released. We achieved a 9.01% return since the fund's inception. We are very proud of that track record. This year we had realized gains. We already have a declaration of dividends and even capital gains. The statement will come out stronger, more complete. Of course, it doesn't have what I call the accumulated appreciation, but at least it's being done year by year and it's being included in the management letter. I really explain all of this, but we are very satisfied with the performance, even though it's a real estate fund and short term.
Until next time. No.
There's nothing else. There's no more time. Until next time on the Financial Game Special.